And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. It's, of course, Halloween. So happy Halloween also means the last day of October, getting ready for the month of November. Of course, lots of stuff happening this week. We've got the Fed meeting on Tuesday and Wednesday, and then, of course, next week is Tuesday, right? Which is voting for midterm elections. I went completely blank there for saying midterm elections next week.
Next week is Tuesday.
I know. Next week we have a Tuesday as well. Happens every week. Speaking of that, starting to forget things when I'm getting older. You want to know how old you're really getting? So this past weekend, my wife and I flew up to Lubbock to go see our daughter at Texas Tech. It was family weekend, right? And so they have a big event going on. They have everything. They have tailgating and everything set out. So we fly up to Lubbock and we're walking around the campus before the game. And that's where they have all the tailgating going on. So they have this whole pavilion set up with live music. And they're playing, they've got live rappers, out there doing rap music, which is awesome. And it's great because it's like from the 90s. It's like Tone Loc.
Oh, that kind.
Yeah, Funky Cole Medina.
Yeah,
so
baby.
What was funny is all the old people are out there, jamming, bouncing around. All the kids look around like, who the hell is this guy? Right?
Stuff.
Haven't you heard of it? So that's how you know you've really gotten old, when you're the only people dancing out there. But anyway, it was a lot of fun. So that's why I'm forgetting things today, obviously.
The next sign is when you hear Tone Loc in the elevator.
Yeah, Tone Loc and Young MC came out and everybody's like, who's this guy? Anyway, it was a lot of fun. They're like going, who remembers the 90s? And all the old people are like, yeah! I'm like, who remembers the 50s?
Crickets.
Anyway, last week, of course, markets kind of struggled on Thursday and Friday a little bit. Because of earnings announcements by Apple, Amazon, etc. And of course, last week, very tumultuous overall. Markets came down and retested that very important 3,800 level that we talked about. And we actually sat right on top of it on Wednesday and Thursday and came down and retested that. Now on Friday, the good news was after Apple's earnings on Thursday, market got a nice bounce, started creating a bit of short covering in the market on Friday. And the market actually not only surged above the 50-day moving average, but also touched the 100-day moving average as well. So very nice retest. I mean, technically perfect. You had a rally above this resistance level at 3,800, tested the 50-day, failed, tested support at 3,800, then rocketed back up through that 50-day moving average. So technically a textbook retest of support. And again, kind of confirms that this rally that we started about 4 weeks ago now remains intact at this point. And this also sets us up now. There's not a whole lot of resistance here between here and about 4,000 on the index, as we've been talking about. It's kind of our target for this rally over the next month. We get this rally to about 4,000. Make sure you sell into it, raise a bit of cash. Once we get into early next year, there's going to be issues, of course, with more rate hikes, slower earnings growth, those type of things. So we still have a lot of things to work through. So again, just kind of use these rallies, reduce risk. When markets get oversold, you can add a little bit of risk. This is just going to be a trading cycle here for a while until we kind of get through this. But importantly, despite the fact that this year has just felt terrible, right? It's just like a terrible year. Markets in this terrible bear market. It's really not. I mean, if you really kind of take a look at the market, yeah, we had this bit of a breakdown right here, but markets have really gone nowhere here over the last 4 or 5 months. It's just been this just sideways grind that just is kind of wearing on investors at this point. So again, despite all the negative activity in the headlines, markets really have been trading sideways here for quite a bit. But again, this rally back up here to around 4,000, 4,100, that's the most logical place to raise some cash. Now, if we happen to break above that, again, now we can, and then do have some technical retests and things of the 200-day moving average that we get above that, then of course we can start talking about what's changed. And again, that could be a lot of things, right? Economic improvement, or it could be the Fed starting to back off rate hikes, whatever it is that gets us there. But right now, until we start to see some of those changes, we have to assume, at least at this point, that we're still kind of in this negative downward trend, at least through the end of this year. But again, we'll just have to take that as it comes. Right now, again, technically, very nice break above the 100-day, the 50-day moving average that sets this market up. The Dow, believe it or not, despite everything that's gone on this year, the Dow is set to have the best 1-month return since like 1938. So it has been a spectacular month for the Dow. The Dow's up over 14% for the month. The Nasdaq's up about 5% for the month. Again, hard to believe despite all this, kind of fallout from Meta and the other big generals in the index. But nonetheless, markets are having a fairly decent month in the month of October. Again, markets look to open a little bit weak this morning. Not surprising, kind of wrapping up the month. A lot of positioning here to wrap up month end. Then we get into November, of course, and again, we're going next week. We've got the Fed talking about rate hikes, etc. So, everybody's being a little bit tentative here about exposure ahead of the Fed. Now, once we get past the Fed, if the Fed, comes in and announces 75 basis point rate hike, that's expected. What everybody's really looking for right now is the Fed to start talking about slowing the pace of rate hikes. Now, that's not a pivot, right? That does not mean they've stopped hiking rates. The markets are kind of taking this idea that the Fed's going to start to slow down their rate hikes as an idea they're about to pivot. That's not the case. Inevitably, the Fed has to slow down the pace of rate hikes. They can't keep hiking at 75 basis points, because they're aware of the lag effect like everybody else. So I can't keep hiking at 75 basis points without at least pausing at some point to wait to see, how those rate hikes take effect in the economy. So just by natural laws, they're going to have to start to slow down. 50 basis points maybe in December, and then you have another 50 basis points or 25 basis points early next year. But that pace has got to slow down, and so that's not a pivot. A pivot is stopping rate hikes and starting to lower them, and they're not going to do that anytime soon, not at this point anyway. But what everybody's kind of looking for at this next meeting this week is going to be the Fed saying, hey, that's our last 75 basis point rate hike. And we're going to start to, 50 basis point maybe in December, start talking about that natural taper. And that's kind of what the markets are looking for. So again, going into that meeting, won't be surprising to see markets kind of flop around here a little bit. Now, the good news is in November, a couple of things happen. We have a lot less mutual fund year ends in November. So you're going to have a lot, there's only a small number, like 5% of mutual funds have year ends in the month of November. That number jumps to 20% in December, and that's typically why in the first 2 weeks of December you typically get a little bit of a sell-off in the markets as these mutual funds go through redemptions, capital gains distributions, those type of dividend distributions, etc. for year end. And then, of course, that's also when you get the year-end rally as those mutual funds put positions back on their books to wrap up the year, have all their allocations in, so when they report year-end reporting, they've got all the right stocks and right weightings in their portfolio. So this is why you typically get that typical Santa Claus rally right after the end, right after Christmas and into the end of the year. But again, so this month tends to be a little bit lighter in terms of action. So as we start to kind of go through the next couple of weeks, get past the Fed, get past midterm elections, that actually kind of opens up the markets to rally a little bit heading into the month of December. So again, more volatility coming up in the month, but typically November is a little bit better month for the markets as well. But again, watch this kind of move that we're doing here. Watch this trend in the markets. We'll talk some more about this on the other side of the break. I'm your host, Lance Roberts. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The end of the year is fast approaching. What will the new year bring? Join Richard Rosso, Danny Ratliff, and Lance Roberts for our year-end economic review special event, Tuesday, November 15th. How to address higher taxes in the new year. Should you delay your retirement in 2023? What will the midterm elections mean for markets? Register now at realinvestmentadvice.com for our year-end Economic Review special event with Ratliff, Rosso, and Roberts. RealInvestmentAdvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show. It is, of course, Monday, Halloween, as we get ready to wrap things up. Everybody's very excited for tonight because it's Halloween. I guess everybody's excited. I know there's in the new neighborhood that I moved into, just tons of kids. So we went last night to buy candy.
Just take out a second loan?
Yeah. Actually, there's an interesting chart out this morning. The price of candy is up almost like 30% over last year. It was when we went to check out, I was like, excuse me, what? and there's a lot less in the bags. You know, you get those kind of mixed bags with all the different kind of candies in them.
Shrinkflation.
Yeah. So higher prices, less in the bag, which is important because on last week we saw consumer spending numbers, and immediately the headlines jumped out that consumers remain resilient in the face of recession. Good old consumers hanging in there doing their job, right? Well, the problem with these consumer spending numbers, as we've discussed before, is that consumer spending is measured in dollar volume, right? How many dollars did we spend? It's not measured in how much we bought, right? Volume of purchase. We don't measure it that way. So you think about buying candy for a second, right? So just as an example, let's say that the average amount of spending for candy bars is, $10. And for $10, I can buy 10 candy bars, right? Well, what happens with inflation and the way that we measure it, so normally we measure it and we say, okay, consumers bought $10 of candy bars. Great, so they bought 10 candy bars. We know that, right? So dollars and volume equate. And so we say, okay, there's no inflation at that point. But all of a sudden, they start charging $15 for the same 10 candy bars, right? So consumer spending is now up because consumers are spending $15, but they're still only buying the 10 candy bars. So, this is the problem. We're not creating more economic activity, right? I'm not having to produce 15 candy bars. I'm still producing the same amount of candy bars. I'm just charging more for them. So when we talk about consumer spending, consumers are having just to spend more money to buy the same amount of stuff. So when you take a look at numbers and it says consumer spending was up last month, and that's great for the economy. That means consumers are just hanging in. No, they're hanging in there, but they're not buying more stuff, creating more economic activity. So if there's a surge in demand, I've got to make more candy bars, right? So if consumers have more money, and this is why we have inflation right now, by the way. So at a point in time, as we've talked about before, and I had this conversation with my liberal cousin Dwayne in Utah, when you can't produce any candy bars because we've now shut down the economy and people are wanting to buy candy bars, the ones that are available, the supplier, the retailer, as an example, says, well, I've only got 10 candy bars and I've got 50 people wanting to buy my 10 candy bars. I'm going to charge $10 a candy bar, right? So because I've got demand for it and I can't get any more, so there's people willing to pay me. Think about an auction, right? I go to an auction and there is the one Twinkie that has been around since 1950, still fresh, by the way. And you put it up for auction and people start bidding on it. I'll pay $1, $2, $3, $5. Some idiot pays $100,000 for a Twinkie made in 1950, right? Well, that's the way it works in real life in terms of the markets. When there's a lack of supply and a lot of people want what supply you have, guess what happens to the price? It goes up, right? That's why you have inflation. Now supply is coming back online, right? We're slowly getting supply back. Now, we're not there yet, but we're getting there. But the problem with these consumer spending numbers is that, yes, consumer spending was stronger last month than expected. But it's not because people have more money to spend. They're having to spend more money that they don't have just to maintain their standard of living. That's why consumer credit is ramping up as fast as it is. Very big jumps in consumer credit right now because I don't have a choice. We've had a big surge in the number of people applying for new credit cards because they've maxed out their old credit cards. They're not going out and getting new credit cards. They're saying, well, I don't have any debt. I think I'll go apply for a new credit card. No, that's not what's going on. They've maxed out their old credit card, and so they need to go apply for a new one. And if I'm worried about, and then of course there's also the fact in terms of new credit card applications, there's all these new applications that says, hey, open up your credit card right now, get 0% interest for 3 months or whatever if you swap your balances. So they're just rolling balances from one credit card to another, trying to avoid that 18% interest. They're not paying off their credit card, but they're opening up new credit to either get access to more of it or try to mitigate the damage of 18% interest rates on credit cards. So again, you've got to really look behind the numbers. It's all these economic numbers. It's just, you've got to look behind it and use a little bit of logic in these economic numbers and just not take them at face value. As we talked about last week, it's excess savings, right? You take a look across Americans, they have excess savings. Really? There's no such thing as excess savings. Having money in the bank is, I guess, excess savings because they've never had it before. But the majority of those excess savings are held by those in the top 10% of income earners. So, these are the things to think about as, you start hearing this economic data about just how resilient the consumer is. And there is no doubt that the consumer is hanging in there right now. But that doesn't mean they're resilient. They're just struggling to try to make ends meet, right? Just trying to pay bills. Recent article out just recently, 60% of Americans live paycheck to paycheck. Really? Well, if 60% of Americans live in paycheck to paycheck, where are those excess savings? Right? I mean, just, none of this makes sense. But this is what you hear on television, mainstream media, et cetera, trying to convince you that everything's okay. And it's not. Now, if you're listening to the show, you're probably fine. Because people that listen to financial talk shows, because they're boring and et cetera, is because you've got money invested in the markets. You want to know what's going on with your money and your savings. So you're probably, odds are, if we take a look at our demographics that listen to this show, right? The odds are you're in the top 10% of Americans, which, by the way, doesn't take a lot to get there. If you've got $2 million in savings, you're in the top 2% of the country. So, I mean, it doesn't take a lot to get in that upper bracket. If you're making more than about $150,000, $200,000 a year in income, you're in the top 10% of income earners, right? It's just, it's a very small number to get in that top 10% because I'm just writing an article right now. I'll have it out next week saying there is no middle class anymore. There is now the top 10% and the bottom 90. There's not a middle class. Middle class used to mean that you could afford a house, a car, a dog, those type of things, and have money left over and have savings in the bank. That was a middle class lifestyle. We don't have that anymore to a large degree because of what's happened in the economy. You take a look at what it takes to, and look, if you've got 2 kids, you'll know what I'm talking about. If you've got 4 kids like I do, you'll really understand what I'm talking about. But raising a family of 4 in America is not a cheap thing. So to maintain that standard of living, right, it requires a certain amount of money to pay for school and clothes and all these type of things you got to pay for trying to raise 2 children in your household. It's not cheap. Mortgage, all that. The problem is that if you take a look at the cost of living to maintain a family of 4 on an inflation-adjusted basis throughout history, the top 10% today barely make enough to raise a family of 4. Top 10% of income earners barely make enough to sustain a family of 4 without going into debt. So if the top 10% are barely maintaining a standard of living for a family of 4, that would be the middle class lifestyle, by the way. Then what about the bottom 90% who don't make enough to do that, right? And we run this chart all the time and we show you the spending gap, which is the gap between what it takes in terms of wages and savings to pay for the cost of living versus how much you have to go into debt every year just to fill that gap to pay the bills, right? And this is why so many Americans have so much debt. It just didn't Americans aren't, let me back that up. Yes, Americans are financially irresponsible in a lot of manners, but in a lot of cases, it's not by choice. They're just trying to make ends meet. And we kind of chastise them and say, well, you should do better financially. You should do these things. You should save and invest and do all this other stuff. And it sounds great. And this is another article I've got coming up is, after 3 major bull markets, why is it that 80% of Americans don't have any money in the bank? I mean, if everything worked the way that we said it works, then why are so many people broke? It's just, but this is why you have, all this stuff in the media now about, inequality and oppression and, we need more socialism and free stuff and, racism. All this is a function, all that is a function of this divide in the wealth that's occurring within the economy. When people feel like they have no option to get ahead, that anger starts brewing. This is why you go back through history. Every fall of every empire has revolved around exactly this type of financial situation. All right, be right back after the break. Speaking of wealth, we'll talk about Mark Zuckerberg and why what happened with Meta is why taxing unrealized gains is a stupid way to manage money. Be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The end of the year is fast approaching. What will the new year bring? Join Richard Rosso, Danny Ratliff, and Lance Roberts for our year-end economic review special event, Tuesday, November 15th. How to address higher taxes in the new year. Should you delay your retirement in 2023? What will the midterm elections mean for markets? Register now at realinvestmentadvice.com for our year-end economic review special event with Ratliff, Rosso, and Roberts. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You have to scratch your head and wonder why Nancy Pelosi on Face the Nation had this to say about inflation.
The fight is not about inflation. It's about the cost of living.
Those are the same thing, Nancy.
The Real Investment Show podcast. Same show, your schedule.
The next iteration of this will be, it's not unemployment that's the problem. It's just that you don't have a job.
At realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The end of the year is fast approaching. What will the new year bring? Join Richard Rosso, Danny Ratliff, and Lance Roberts for our year-end economic review special event, Tuesday, November 15th. How to address higher taxes in the new year. What will the midterm elections mean for markets? Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
So speaking of Halloween, I was watching this video yesterday, and this kid's yelling at his mother, basically because it's like, I don't know why you're worried about drug dealers lacing the candy this Halloween. They're not giving away fentanyl for free. It's like, yeah, you got a point.
Yeah. It's too expensive.
We, got to check the candy, bro. You know. Raising kids, that was always the thing. It's like, got to try to somehow get it away from them a little bit so they don't all wind up in a corner.
I think that was a ploy, actually, to make you come home and dump all of your candy out on the floor so your parents could cherry pick it.
I don't know why you're blaming other parents, because you did it too. I did it.
Yeah.
I was like, yeah, dump it all out. Let's check it. Yeah, there's the Snickers
those
bars right
orange
there.
and yellow ones, you don't like those.
Yeah, those are terrible.
Reese's
Those
are bad
look
for
bad,
you.
right?
Yeah.
Then there's always that one neighbor that puts apples in people's bags. Like, what is this? Anyway.
Kind of fruit.
So, one of the things that has, been talked about here recently, especially since the onset of the new administration, has been figuring out more ways to try to tax the wealthy. Now, fortunately, they haven't figured out how to get anything passed, but there's been lots of talk about, a variety of things. Remember, they wanted to get rid of the carried interest tax loophole for hedge funds. And that was, going to be in that whole, infrastructure green energy bill that they were passing. And the only way it got passed was to get Kristen Sinema's vote to pass that bill, and she killed that reversal of that carried interest tax loophole in order to get the bill passed, right? So they weren't able to do that, which would have put a big tax on hedge funds. But it's interesting, too, because there's been lots of other conversations. One of those was we need to start taxing unrealized gains. All these rich people, right? They have all this stock in corporations. Elon Musk, Jeff Bezos, etc. And we've talked about this on the show before, is that the way that it works for these CEOs of these big major companies that have these massive amount of stock options and stock, et cetera, is that what they do is instead of selling their stock and paying tax on those gains in the stock, but also, too, it's also a function of protecting the stock price. If the CEO starts dumping a lot of stock, the theory is that they know something is coming bad for the company. So if they're selling stock, then I probably need to sell mine, right? That's why we look at insider buys and sells all the time. So if a CEO is dumping a bunch of stocks, that's not a good thing for the company. And a lot of these companies' financings, debt offerings, et cetera, potentially have covenants about their stock price. They have to maintain their stock price at a certain level. So for a lot of these CEOs, they don't have the affordability of going out and just dumping stock that they own to go buy their $50 million palatial mansion in Florida, right? Can't do it. So what do they do is they go to the bank and Elon Musk walks into, JP Morgan and says, hey, I need, $50 million. I want to go buy this house in Laguna Beach, whatever. And they just say, okay, great. Just pledge some of your stock and that'll be fine. And we'll make you the loan. And I mean, it's a very easy transaction. So they just pledge stock to the bank in exchange for, whatever money they're taking out to go buy stuff. So that's a tax-free transaction, by the way, because they borrowed money to go buy this house. So a lot of the media has been going, well, this isn't fair because all these rich people are going out. They're making all this money. They've got all this wealth, right? They've made billions of dollars in wealth and they paid no taxes. Then you agree, right? So if they take a salary, they're paying W-2 income tax on that or whatever. But, majority of their wealth is tax-free because they're borrowing against the shares in order to extract value. Now, at some point down the road, if they ever sell the shares, like Elon Musk did, then you're going to pay taxes. And, he's paid more taxes in 1 year than any other human being in history because of selling shares. But that's not the way it works normally. So one of the workarounds that government has been trying to get in here is to start taxing unrealized gains, because that way, as Elon Musk wealth improves, so he makes his stock goes up and he makes $100 million more in market value, with my quote fingers up, then we charge him on $100 million of unrealized gains. So that sounds great. So Elon Musk has got to come out of pocket for, $30 million, $37 million, $38 million, whatever the number is, after his standard deductions, et cetera, to pay for his capital gains, right? So this was a way to go after all these rich people to get more taxes. Well, here's the problem with it. See, it's all fine and dandy when things are going up in price. It seems completely logical. But what we found out last week is the other side of that story with Mark Zuckerberg. His stock is down roughly 80% from the beginning of this year. And last week, that decline in the stock just added to the woes, right? So this is a very big decrease in his net worth, but it's unrealized. It's an unrealized decrease. Do you see where I'm going with this? Brent's over here nodding his head. So if I can charge Mr. Zuckerberg for his unrealized appreciation, if I can tax him on the unrealized appreciation, Mr. Zuckerberg now has an unrealized loss that he can write off on any of his gains. And it's really kind of where this brings up, the problem with this whole idea of taxing unrealized gains. See, we always think about it in terms of just one thing. This guy's made so much money and he's never paid tax on these gains because he's been going to the bank and he's been borrowing the money against his shares this whole time in order to fund his lifestyle. So he's never paid income tax on this stuff. We need to go after it and get these unrealized gains. Well, the problem comes when they lose money, and they do lose money from time to time. Mark Zuckerberg is case in point this year. Elon Musk has lost a good bit of money this year in terms of valuation with Tesla shares. So now, theoretically, remember last year, Elon Musk paid a lot of income tax on the shares he sold, and he paid capital gains tax on those shares. Now, theoretically, he would now have a deduction to go back and reclaim some of the. He would probably like this, actually, because now he would, if you were allowing him to be taxed on unrealized capital gains, he could go back and claim a loss, right? Get some of those income tax dollars back. Well, now the left goes haywire. Well, that's not fair. So wait, I can only have a tax on unrealized gains, but I can't have a tax loss on unrealized gains, unrealized losses, right? So we have to start doing all these maturations about trying to figure out how to navigate this. But the point about this is this is always the problem with these kind of half-handed measures that politicians come up with because they never think through the process. And this is the problem with all the kind of all the government spending and programs and things that we do, like student loan debt relief, right? Let's forgive student loan debt. Okay, well, what about the people that had already paid off the loans? Do they get a rebate? What about the people in the future? You're going to keep writing off loans in the future? I mean, I just go out and theoretically I can go out and take a loan and then immediately get it forgiven. So, what have you created here, right? So we never think about, the unintended consequence of these actions. We just go out and do stuff, right? Let's send checks to households and shut down the economy. Nobody thought about what except we were talking about it here. We wrote articles called The Sugar Rush talking about this is what's going to happen, and here's where we are, right? But nobody ever thinks about these things, right? We just go off this stuff kind of half-cocked. It sounds really good at the time, but we never think about the consequences. Well, here's a good example with Meta about the unintended consequences. If it would have passed, right? If they would have gotten this passed. Now, thankfully, they didn't get it passed. But had they passed a bill to tax unrealized gains, would have been a problem. And then we'd have a whole bunch of other people now up in arms. But this is the issues, right? That we continue to deal with. We keep making these decisions based on not even half the facts, right? Generally just no research. This sounds good. It appeals to my base, so we're going to do this, right? We need to go after all the rich people because all the poor people hate the rich people, right? The rich people over here are going, let them eat cake. And they're going, I don't like cake. And that's the problem. So we pass stuff or try to pass things that appeal to it. And then we wonder why we get these consequences down the road that everybody doesn't like. Anyway, all right, quick break. Be right back. Wrap up the show. Don't go away.
investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The end of the year is fast approaching. What will the new year bring? Join Richard Rosso, Danny Ratliff, and Lance Roberts for our year-end economic review special event, Tuesday, November 15th. How to address higher taxes in the new year. Should you delay your retirement in 2023? What will the midterm elections mean for markets? Register now at realinvestmentadvice.com for our year-end economic review special event with Ratliff, Rosso, and Roberts. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So, if you live in the Houston area, it's supposed to be very nice tonight in the mid-70s. When we were in Lubbock this weekend, it was about 48 degrees at night. It was pretty chilly up there.
Yeah.
But yeah, in the Houston area, it's going to be pretty nice for trick-or-treating tonight. It's supposed to get some rain very late tonight. But as you start to move up, northeast Dallas is down in the 50s, and you're going to get up into the 40s in Spook City.
Spook City,
47 degrees expected tonight. So be a little chilly. So wear some warm clothes underneath your costume if you live in Spook City. There's some great names there are some cities in this country that have some great. You have to wonder where they came from,
especially in Texas.
Yeah, but yeah, Cut and Shoot.
Yep.
That's a good one.
Yeah.
But yeah, there's some great names of cities around the country that it's like who thought of naming the city that? And
fires the imagination.
It does. We talked, as markets get ready to open this morning, Dow, S&P are down a little bit this morning. Not surprising after that big move on Friday. Not surprising to see a bit of a pullback this morning. So when we think about it, look, we've talked about this before, and I wanted to put some numbers with it, is to, we look at the markets on a year-to-date. We've all been trained, right, to look at the markets year-to-date. How am I doing this year, January 1st till now? And the problem is we're all matching against that high water mark, which high water marks are never a good way to measure your portfolio performance because, it's not indicative of what your portfolio has been doing over time. And it also is not indicative of what you should be doing, what your money should be doing to reach your goals, right? And there's some different ways to look at that that are better. And we talked about this before, is that instead of looking at your portfolio on a year-to-date basis, look at it on a 2-year rolling basis, right? So where were you 2 years ago versus now? Or look at it from January the 1st of 2020 till now, whatever, right? But pick a longer term period. Here's some numbers for you, by the way. Since the beginning of 2020, the S&P is still up 18%. So 2020, 2021, and we're almost through with 2022. So, if my goal is 6% a year, I'm still there, right? 6 times 3 is 18, and S&P is up 18%. So if my goal is to reach retirement, I need 6% a year, you're still doing okay if you're invested in the S&P, right? You're still right on track, even with the pullback. So yeah, I know this year's felt terrible, but it hasn't derailed your financial plan at all, right? Still on track. Apple's up 97%, Microsoft up 44%, Google's up 38%, Amazon's about flat. The sole exception, of course, is Meta, which is down 52% since 2020. Tesla's up 70%, Nvidia's up 124%. Now, when we take a look at annualized rates of return, that's how we measure our portfolio. What's been our annual rate of return in our portfolio, compounded annual growth rate over some period of time, right? I need 6% a year. That's my goal. On a 3-year CAGR, which is the compound annual growth rate, Apple's up 27%, Microsoft 19%, Google's up 25%, Amazon is basically about 0%, Tesla is up, Meta is still up 15%, and Nvidia's up 14%. So, again, when we take a look at these numbers in different measures, all of a sudden it's like this year doesn't mean that much. And yeah, the markets are down a bit. They're down less than 20% this year. And it feels terrible because the markets have just gone nowhere this year, right? It's just been a consistent struggle, so emotionally draining. But this is where we start making mistakes with our portfolio management because we're so focused on the right now versus where we've been and where we are, right? And this is the important thing about portfolio management, is not letting these short-term emotional swings in the markets drive us to make investing mistakes that impair us long-term in terms of our investment goals. And so this is why it's important when you take a look at your portfolio and it's okay, everybody measures everything, year to date, right? We look at everything year to date. And the media drives us to do this. Why does the media drive us to do this? Is because this is the way Wall Street wants us done, because Wall Street wants to keep money in motion. This is why in up years, they tell you, well, if you didn't beat the index last year, you should switch portfolio managers and find somebody who beat the index last year, right? And so all of a sudden I'm going to chase last year's hot performer. Well, the problem with that is, and I just posted this periodic table of returns out on Twitter this morning. So if you go to my Twitter feed at Lance Roberts, you can see this periodic table of returns. But if you study that chart, what you'll see is that whatever was this year's best performer, which is what everybody's telling you to jump into, typically turns out to be next year's worst performer because things rotate and vice versa. Whatever was the worst performing thing last year tends to perform a lot better this year or the next year. And they swing, up and down because of that. So it's important to not get sucked into that hype. But that's what Wall Street wants you to do, because every time you start jumping from one portfolio manager to another, you switch advisors, you switch your portfolio, you have to sell all your stuff to buy all new stuff, and that creates fees for Wall Street, right? So they make more money. So Wall Street is always about keeping money in motion, and that's why we have all these short-term metrics about measuring your portfolio year to date, right? Month to date, this week. We talk about everything in really short-term windows so that we lose focus on what's important, which is the long-term growth of our portfolio over time. How are we doing long-term? And by doing that, once you start to set aside all these short-term metrics and start looking at your longer-term portfolio performance, where were you 3 years ago versus where you are now, all of a sudden you go, oh, I'm okay. I don't have any stress. Now, that doesn't mean you shouldn't pay attention to risk and do those type of things and just, blindly close your eyes and just, not pay attention to things. there's some consequences to that. But what's important is to not make emotional decisions to say, oh, I'm getting all out of the market, right? I'm going to go change my managers. I'm going to go do this. I'm going to do this, whatever. Because typically that gets you into a worse position over time. And generally by the time we start making those big major changes, we're near the bottom of a market anyway. So you wind up hurting yourself again by paying more fees and doing those type of things. You know, one of the things is if you take a look at where the market is right now, money's been flowing out. So let's talk about next year and the year after. Commodities have been the top for the last 2 years. And when we talked about this in late November 2020. We were talking about how energy was so hated that commodities and energy stocks were destined to outperform. And boy, have they outperformed. Been doing great. So now everybody wants to own energy and commodities. Now, what does that tell you? Right? So energy and commodities have been the top two performing asset classes over the last 2 years. Now, if you're a betting person, where would you put money next going into next year? Would you buy more energy? Now, your psychology says, yeah, it's been kicking ass and it's just going to keep going up and there's no reason it's going to ever come down again. But history says that whatever is the best performing asset class over any given 2-year period typically turns out to be the worst performing asset class over the subsequent year or two. Now, there's been times that a top performing asset class has made it 3 years, but I can't find any period where it's gone longer than that. But, so let's just get back. What's the worst performing asset class over the last 2 years? Nope, it's not the S&P. It's not bonds. It's emerging markets. So if you're thinking about where to place money going into the next year, as a contrarian investor, what should you be looking at, right? But where's money been flowing to, right? So money's been flowing out of big tech and flowing into energy stocks. And that's been to a very large degree of this rotation. So that suggests that, now here's what's interesting about this too. Energy only makes up 5.52% of the index, right? And so the money flows that go into that have an outsized proportionate effect on the overall performance of the market because of that increase in that market. So energy used to be 2% of the index, now it's 5%. So it's become a much larger weighting because of the valuation increases in these stocks. So that's where money flow has been going to, coming out of tech, going into energy for the last 2 years. So there's some things to at least be thinking about. I'm not telling you that, sell all your energy stocks that they're going to bust next year. I'm not saying that at all. I'm just saying there's some things to think about. Right now, everybody loves energy, hates tech and bonds. Bonds have had the worst return since 1778. So, we were signing the Declaration of Independence the last time that bonds performed this poorly. Historically, that's a 1-year event over the last 200 and some odd years, right? So just thinking about next year, where you're going to be placing your bets. Anyway, wraps up the show for the day. Get by the website, realinvestmentadvice.com. Get our latest blog posts. Our newsletter is out for this weekend. So much more. It's right out there for you. realinvestmentadvice.com. Have a great day. We'll see you back here tomorrow.